Hello everybody, this is Eddie Ghabour, owner of Key Advisors Group. Please subscribe to our YouTube channel for up-to-date videos, economic updates, as well as positioning that we've done for our clients that we share with you to hopefully help educate you and put you in a better position to make changes that you feel is best suited for you and your family. So we've been getting a lot of attention lately because of the fact that we made the market call back in November that we were really concerned about the setup for 2022. And we were slowly rotating out of what we thought were our higher risk assets. We were rotating out of small caps. We were rotating out of technology. We were rolling out of our high beta ETF holdings that we had, minimizing our emerging markets exposure. Anything that we thought could have a big drawdown due to the fact that we thought the economy was going to slow down. And we thought the Fed really pigeonholed themselves in a way that they were going to be forced to tighten, in our opinion, at the worst possible time anyone could want to tighten, which is while the economy is slowing down. And so the question we've been getting is, well, where have you been putting these assets? Where have you positioned? Why have you positioned it there? And should I go all cash, no all cash? And look, at the end of the day, we all make calculated bets. We don't know what's going to end up being right. You just have to do what you think has the highest probability of success. So there's not a one size fits all. But what I will do is share with you really what we did from a positioning perspective in our tactical strategy that we manage based on shorter term time horizons to try to risk manage a part of our client portfolios to, again, the goal is to minimize volatility, maximize returns when we think the opportunity is there, but when we become bearish is to really try to be as cautious as we can. And so when you look at an economic slowdown in the past, right, and history is only history, but that's some things that we look at to try to educate ourselves. When you're going into a recession or you have a bear market, many times you'll hear the term the flight to safety. And the flight to safety could be things from treasury bonds, utilities, consumer staples, precious metals, cash, laddered bonds, municipal bonds. So there's lots of different strategies. And again, it's not a one size fits all. So what we did in our tactical strategy was we got completely out of the ETF that was tied to the NASDAQ. We got completely out of small caps. And we started incrementally buying things like consumer staples ETF, utility ETF. We did have real estate. We got out of real estate in our ETF strategy because, again, the things that we follow weren't showing to be very positive for that space. We have precious metals, treasuries. I mean, look, this is boring portfolio holdings traditionally, but boring, in my opinion, is good when you're heading into a bear market setup. And that was what we thought the setup was. And when we make these changes, and I encourage you to kind of look at your strategy, we do them incrementally. So we're never going to be so arrogant to think that we know the exact right time to buy any asset, because no one really knows. But if you have a strong conviction versus jumping in with both feet on that position, figure out what you want to do is maybe what your top percentage you want to own in that asset class, and then slowly add to it. And that's exactly what we did November, December, and January until we were really in the position where we wanted to be. And there have been days where we've had some really down days in the market, and you look and the treasury ETFs are up, the utilities are up, the staples are up, the boring considered flight to safety type of assets that generally do well in a slowdown have had some good days. Now, on the flip side, when we've had bear market rallies or a rip in the market, those boring asset classes really underperform. So you have to understand that. That's why, in our opinion, you don't go all in any one area. But when you take a look at the dynamics and how they unfolded, our thought process was we want to try to be in places that we think the consumer still has to go to in a slowdown, all right? So we didn't want to own a lot of discretionary items that they're going to have to or potentially minimize in their budget because they're spending so much money on gas and food, rent. I mean, this inflationary issue that we have is broad-based. It's not just concentrated in oil. Oil gets the headlines, But when you take a look at the dynamics of the inflationary pressure that we have, one can make the argument that it's really across the board on a lot of the things that we use day to day. And so that's why we really wanted to get away from the discretionary items that they're going to have to cut back on in order to meet their day-to-day living expenses. So we wanted to be really underweight those areas. We definitely wanted to be out of technology because traditionally when the growth phase is ended, those areas seem to get hit the hardest, and there have been some technology companies that have really taken a big hit. But again, from a portfolio construction perspective, it's nice to be able to hedge a certain percentage of your portfolio from a risk management standpoint. So that way, when the market's down 300, 400, 500 points or 1%, 2%, you could potentially still have some green days on part of your strategy. And what that does is it helps minimize the total drawdown, okay? Because at the end of the day, everyone looks great and everyone looks smart in an up market. A true test of how well your portfolio is positioned and how well it's managed is how it does in a bad market, okay? Because if you're going to lose 2 years worth of gains in 6 months because you weren't positioned for a correction or a crash, then at the end of the day, what good is it, okay? And my job with our clients and my team's job with our clients is to do the best that we can to minimize drawdowns. And that's why we felt it was absolutely critical to position in the staples, in the utilities, in the treasuries, into the precious metals, and cash. We have cash because we want to be able to buy the dip when we feel as though we're close to a bottom, okay? And I'll leave you with this. A lot of people will come on TV and say, buy the dip, buy the dip. And there are times that is the great call to make. But at the end of the day, if you're worried about a drawdown, you need to make sure you have something left to buy the dip with. Because if your portfolio is down 30%, what are you really benefiting by selling that and buying something else that's down 30%? So this is a little bit of things for you to think about in regards to how to tactically potentially position portfolios, and really some insight onto what we do for our clients with a percentage of their assets to, again, hedge against drawdowns. There's no guarantee that any of this works, but all I can tell you is if you have a disciplined approach, our hope is that we'll have a pretty good batting average in regards to picking winners and losers in regards to what sector to be in based on what economic cycle we're in. So I hope you got a lot out of today's educational video. More importantly, I hope it's something that you can use for you and your family. So I wish you the best of luck and make it a winning week. Thank you.